Hi everyone, welcome back to my channel. So today we are diving into some of the most famous candlestick patterns that actually work in the stock market. If you have ever wondered how traders spot reversals and ride trends early, this video will give you a clear insight with real stock examples. So stick around till the end because this could seriously sharpen your trading game. So the first pattern in our repository is the hammer. We call it a mighty hammer. How does a hammer looks like? A hammer looks like a small body at the top with long lower wick, appearing after a clear downtrend. So the psychology behind forming this pattern and how this pattern is useful is as follows. So the sellers pushed the prices down. That's why the lower wick has been formed. But buyers fought back successfully. That's why the closing is near the high where the candle has opened. So this signals a bullish reversal. So here is the actual example of a stock named ITC Limited from March 2024. If you will see at around 12th of March, a hammer has been formed after a downtrend. The next day, the stock has opened gap up, and if you'll see, it has rallied from 370 support level to 420 plus within 3 weeks, and that is a 13.5% gain. So that's how a hammer can be useful in your trading journey. So the next pattern in our repository is the shooting star. So the shooting star is the mirror image of the hammer. It has a small body at the bottom and a long upper wick. It usually appears after an uptrend, showing that buyers pushed the price up but sellers quickly rejected it. So this signals a potential bearish reversal. So let's take a real life example wherein a shooting star has been formed over the Nifty chart at around 10,800 level and it dipped to 10,400 levels in just 6 trading sessions. So the shooting star formed at a resistance level is a very good sign of a potential bearish reversal. Now here's the trick. These two look almost identical. The difference lies in the trend context. Hammer after a fall means a bullish sign. Shooting star after a rally means a bearish sign. So always check the previous trend before acting on these patterns. But remember, both patterns require context from the preceding trend to interpret correctly. Without trend context, these patterns lose much of their predictive power. So the third pattern in our repository is the Doji pattern. We call it the mysterious Doji because it has almost no body, meaning the opening and closing prices are the same. So the psychology behind it is it represents a perfect equilibrium between the buyers and sellers, indicating indecision and potential trend exhaustion. So a bonus tip of playing a doji is that they gain significance when they appear at key support or resistance levels or after an extended trend. So they generally indicate a potential reversal. So here's the example from the Nifty 50 chart, wherein you can see how a doji, when formed at the bottom, has actually resulted in a rally, and when a doji has formed at the top, has resulted into a correction. So if you will see in August 23, doji has formed at around 19,300 level and has actually taken Nifty to around 20,200 level, wherein at just right at the top at around 20,200 level a doji has been formed, wherein a correction has started post that formation and has taken Nifty to around 19,400 level. The next patterns in our list are the engulfing pattern. Let's start with a bullish engulfing pattern. So in bullish engulfing pattern, a small red candle is followed by a large green candle that fully engulfs it. This shows buyers overpowering sellers, which indicates a possible trend reversal. On the flip side, a bearish engulfing is when a large red candle swallows a small green candle. This shows sellers taking charge. So here's the example of the HDFC Bank, wherein you can see after the bullish engulfing pattern has been formed, the HDFC Bank shares has rallied from 14,040 to 1550 in just matter of 7-8 trading sessions. Similarly, you can see formation of a bearish engulfing pattern in Reliance Industries stock, wherein the Reliance, after a bullish engulfing pattern has been spotted, has corrected from 1240 levels to 1150 levels. So before jumping into how to confirm candlestick patterns, here's a golden rule. Single patterns alone aren't enough. Confirmation is crucial for increasing success rates. You can look out for volume confirmation, wherein look for above average volume on the pattern day, indicating stronger conviction, or you may look for support resistance alignment, so patterns forming at key levels or previous high lows have higher success rate. In the further videos, I'll be explaining regarding the technical indicators agreement, wherein, for example, I will be teaching you regarding RSIs, wherein if an RSI is in an overbought zone or an oversold territory, how a pattern formed at that level can increase the success rate. Or then you can wait for the confirmation candle, wait for the next day's candle to move in the expected direction before entering. So the common mistakes to avoid after knowing these patterns is these patterns alone are not going to work. So if you are hunting for these patterns without confirmation or context, the success rate is going to dip. Also remember, the patterns formed on a very short time frame can result in the reduction of the success rate, because there is a lot of noise in the short time frame. So these patterns works on a longer time frame. Also, there is a very famous saying in the stock market is ride the trend. So trading against the overall market direction based on a single pattern may reduce the success rate. And the most important point to follow in the stock market is the risk management. Because do remember, even the best patterns fail 30 to 40% of the times. Always use stop losses and position sizing. Also remember, because traders are chasing 100% accuracy in these patterns, so more than 80% traders abandon once the pattern fails. So how do you start? Let's start out your action plan. Start with practicing by recognizing the pattern. Spend 30 minutes daily reviewing charts of 5 major Indian stocks to identify patterns. Paper trade first. Track 20 pattern setups without real money to calculate your personal success rate. Third, start small. Begin with 0.5% of capital per trade until you achieve more than 60% success rate consistently. And the fourth point is very important. The fourth point is keep following the channel, because this is not the end, this is just the beginning. And in the further videos, we will be learning 3 candlestick patterns like morning, evening stars, and pattern combinations for better accuracy. Remember, consistency beats perfection. Focus on process over results, especially in your first 50 trades, and you will be successful in your trading journey. If you found this video helpful, please press the like and subscribe button. It motivates me, and I will meet you next time. Thank you.